Now, let's continue, ladies and gentlemen. Hey guys, welcome again to my channel. So we're going to continue the shareholders equity. So we are through with the issuance of shareholders, comparison it with the partners equity, owners equity. We're through with the accounting for treasury shares. We're through for we're through for accounting for retained earnings and dividends. So right now, let's go to the other concepts that you might need to understand so that you'll be able to solve the whole shareholders equity. First off, you have to know about trust fund doctrine. Although you have already heard this in the past episode, trust fund doctrine is actually the very main concept of trust fund doctrine is, where is the, yeah, let's have this. On the trust fund doctrine, don't um, withdrawal of legal capital is not allowed. So that's the shortest, the most straightforward definition of the trust fund doctrine. So of course, we have some contributed capital and we have legal capital that we're gonna talk about. Okay, so the legal capital is actually, since the A is equal to L plus C, this is the corporation in your minds. So part of the shareholders equity is a legal capital. Like for example, if we're talking about ordinary shares, the par value of such ordinary shares, that is considered the legal capital. So meaning, if the investors have given 5 million, for example, to the company, and then the OSC is about 2 million, and the other one is the OSC share premium, 3 million, trust fund doctrine says that you cannot give the OSC or the ordinary share capital at par. It also means that you can give this back, the ordinary share capital share premium. Okay? So that is if we're going to talk about par value shares. Okay? Now, why is it, before we go to the other type of shares, why is it that the legal capital is prohibited from being withdrawn by the shareholders? It is because to protect the third-party creditors. As far as you remembered, as far as I remembered, I already told you that the shareholders have a limited liability. Their liability is only up to their investment. Okay, so meaning, if this happens, 10 million is the total assets of the company and the liabilities is about 20 million, then that means the 10 million assets cannot suffice in the payment of 20 million third-party creditors, what do you call this, claims. Okay? So if that is the case, the creditors have no recourse already to, to they can collect this, but they cannot run after the shareholders because again, the shareholders has a limited liability and that is only up to their contribution, which is why trust fund doctrine has been made, so that the shareholders equity will always be positive and will not be negative. The legal capital cannot be withdrawn. Okay? However, if we talk about no par shares, no par shares. Sample, there are no par shares of 1 million. What is the meaning of no par shares? No par shares, that means there is no par value on the documents that was submitted to the Securities Exchange Commission. So again, with par value is with minimum amount of money to sell your shares, each of the shares. So meaning, if par value and the par value is 10, you cannot sell it at below 10 pesos. No par shares are actually grouped into two. We have, I'm so sorry, we have with stated value and no stated value. So how is it different? On the accounting side, of course, the with stated value example, there are 1 million no par shares, but they have a stated value of 10, then that would mean if these no par shares are sold at 20, the entry will be debit cash 1 million times 20 equals 20 million. And then OSC, but we have the stated value. It's as if you are just changing the par value to stated value, which is 1 million times 10. That stated value, it's 10 million. And we have OSC, share premium, 10 million. That is the stated value. So in the share certificate that you're going to issue to your shareholders, of course, the stated value will be there. It's at 10. And the accounting is very much the same with par value, right? Now, as to no stated value, on the no stated value, there should be a minimum value of 5 per share. That is constant. That is under the law. So, if there is 5, then what will happen is, if this is no stated value, 1 million times 20, 20 million, the OSC, the stated value will become 5. Even if there is no stated value, we have to put 5 here. So we have 5 million, and the OSC share premium will become 15 million. So that's the accounting for the with stated value and no stated value, no par shares. Okay? Now, let's go back. We're talking about legal capital. Again, for par value shares, the legal capital is the par value of the shares. Okay? How about no par shares? The no par shares, um, all of these are legal capital. All the contributed capital are considered legal capital. So even if this is 10 million is based on the stated value, that is part of the legal capital, including the share premium. It's part of legal capital. Okay? Now, on the par value shares, if the par is only 2 million, that is only the legal capital. The 3 million, although, if you're going to be asked what is the contributed capital, the answer would be 5 million. Because what was contributed maybe in this one, it's either cash, services, or non-cash asset. It is 5 million. However, on the OSC par, since it is based on par value only, it's 2 million, and the excess is on the 3 million. Right? So, again, let me summarize on par value shares. What is the legal capital? No. Let's start from the very beginning. Trust fund doctrine, if you hear that, it just means that the withdrawal of the legal capital is prohibited in order to protect the interests of the third-party creditors. As to what is included in the legal capital, it depends. If we're talking about par value shares, the total par value will become the legal capital and it should not be withdrawn. But if we talk about no par shares, the total contributed capital, including on the share premium, including everything, are considered as legal capital and must not be withdrawn. Okay? Now, lastly, what are the twists on this legal capital? When we talk about legal capital, we have 2 million right here and we have 20 million in the no par shares, for example. If there is a subscription receivable, it should be deducted in order to get the legal capital. For example, there is an unpaid subscription of 500,000. That should be deducted from the 2 million subscription receivable. But if we talk about subscribed share capital, if you remembered, the subscribed share capital is basically the same with the ordinary share capital account because it is stated at par also. However, it is still subscribed. It has not been paid for. There is no issuance of share certificate yet. Not the same with this one. There is already an issued share certificate. What are we going to do if ever you'll be asked how much is the legal capital? You have to include the subscribed share capital at par because legal capital includes all the par. Okay? So, what's the formula if ever you're going to be asked about legal capital? The legal capital is all the par values of par value shares, which includes OSC, par value, subscribed share capital, par value, and preference share capital if ever. We're going to talk about preference share capital later on, par value. Okay? And you have to deduct the subscription receivable in order to get the legal capital using par value shares. Also, on the no par shares, you have to include everything including the share premium. And you deduct the subscription receivable, and you add also the subscribed share capital. Okay? The only twist is that sometimes the subscription receivable is not part of shareholders' equity. As I've said to you, if the subscription receivable is collectible within 1 year or less, it will go to the asset side, the current asset side. So if that is the case, you don't need to deduct the subscription receivable already to get the legal capital because after all, the subscription receivable is not already a member of shareholders' equity, it's part of the assets. Okay? So that's it. So basically, we have talked about trust fund doctrine, legal capital, and no par shares. Okay? And contributed capital also. Contributed capital is the total contribution of the shareholders. Okay? Now, what's the next one? The next one that you need to understand is the pre-emptive right. Pre-emptive right. I'm so sorry that it is not as arranged because we are now in the portion discussing a lot of random things that you need to understand in shareholders' equity. So we have pre-emptive right. What does it mean? For example, there are 100,000 shares outstanding to shareholders. And we have A, we have B, and the others. For example, A owns 10,000 shares, that is 10% ownership. And B has 30,000 shares, that is 30% ownership. And the others is owning 60%. 60,000 shares, 60%. Now, that is the composition. And I have told you, the more ownership that you have of the shares, that is also your influence in the company. Like for example, if A has 10%, that's big in some companies, but in accounting, that is not yet a significant influence. But when we talk about B, there is a significant influence already. And imagine if ever this others is actually C, 60%, C has control of the corporation. So, based on your ownership with the shares of a certain company, you can exercise significant influence or control if ever. So, meaning, A and B here in our example should maintain their ownership share. So, what is preemptive right? For example, if what was authorized by Securities Exchange Commission is 100,000, no, 200,000 shares, and you only sold 100,000 shares yet, that is outstanding, and you are planning to issue, to sell. You have sold at first 100,000. If ever you are planning to sell the 10,000 additional shares, you have to consult the old shareholders if they wanted to buy some shares, additional shares to be issued. Why? Because they have to protect their equity ownership. and their power also in the corporation, especially B in this case. So that's what we call as preemptive right. Okay? So the additional shares to be issued, they have to be consulted first with A, B, and the others so that they could maintain their 10%, 30%, and 60%. Like for example, A, you said, we're going to issue additional 10,000 shares. So A should be getting 1,000 shares so that it will become 11,000. A will retain 10% ownership because 100,000 plus 10,000 is 110,000 already. Having 11,000 is still 10%. Okay? So that's preemptive right. Okay? So after those, what do you call this? Concepts, let's talk about different types of accounts that might be included also in the shareholders' equity. As of now, we have a lot of things already. If you can still remember, these are the accounts that we talked about. We have the ordinary share capital, that is an addition to the shareholders' equity, and the ordinary share capital share premium, that is an addition to the shareholders' equity. And then, aside from which, we have subscription receivable, subscribe share capital in our past videos, that is to be added, subscription receivable, if this is not yet collectible within 1 year or less, it's here, but it should be deducted. And we have treasury shares. Yeah, treasury shares is a deduction. But we have treasury share premium, that is to be added to the shareholders' equity. We have also talked about the account retained earnings unappropriated, that is to be added, as well as the retained earnings unappropriated, that is also to be added even if it is appropriated. Aside from which, the latest is the share dividend payable. So basically, we have lots of accounts that are already discussed. However, that is still lacking, guys. So let's talk about what are the other things that could be part of that. So first off, let's have, where is my eraser? Oh no. Let's get another one. So let's talk about those accounts that should be added in that. Because if you will be asked how much is the shareholders equity, you might have to know. You have to add and deduct and then get the total of the total shareholders equity. Oh no, we have also fractional shares outstanding. I guess you have lots already. So, what is the other one? We have preference shares. So, preference shares is not, it's not really the same with the ordinary shares. The ordinary shares for me are the real owners of the corporation, whereby if you buy ordinary shares, you will have really authentic, what do you call this, power in making decisions for the company. Really. I don't know why they Okay, I have here one. So, on the preference shares, you still have the same entry. In which, for example, you have 100,000 preference shares with a par value of 10 sold for 20 a share. So the entry will still be the same. So debit cash, the same with the ordinary shareholders. However, we're talking about preference shares already. So 100,000 shares times 20 equals 2 million. And then PSC or preference share capital, it's still at par. So we have 1 million and the PSC share premium 1 million. The point is, there is already preference shares. However, the accounting is very much the same or similar to ordinary shares. The question is, why is it called preference shares? Why not ordinary shares if the accounting is so similar? Preference shares is actually like this. 100,000 times 10, this one. It's not only the preference share capital with par, there is a percentage for that one. That is not present in the ordinary shares. So what does that mean? That means if ever there is a net income, because normally preference shareholders are preferred as to income. So 100,000 times 10, 1 million times 10%, they are to get 100,000 if ever there is a net income. Okay? So meaning, if the company has 200,000 net income, 100,000 will go immediately to them because of this percentage. This percentage is multiplied with their par value. Okay? However, in decision making, mostly the ordinary shareholders are the ones who would have a significant influence or control over important decisions of the company. And then, they are considered as the real owners, the ordinary share capital shareholders. It's because they are the ultimate risk takers. And even if they are the ultimate risk takers, they are not preferred as to income. For example, the net income will be 1 million. So 100,000 will go to the preference shareholders. So the 900,000 will go to the ordinary shareholders along with the control and significant influence if ever. Okay, so that's the difference. Sir, is the preference share capital as if debt already? Debt, that means the shareholder is actually a creditor because there is somewhat like an interest rate. Yes, this is somewhat like an interest rate. But then again, preference shareholders or preference shareholders are only entitled to the 10% if there is net income. And also, on the debt, there is a maturity term wherein if, for example, we took 2 million from a bank instead of selling preference shares, just like this one. So cash, credit, loans payable, 2 million. The 2 million principal will be paid after the maturity term. Whereas here, the preference shareholders will not be expected to receive the principal, the 2 million that they have contributed anytime soon. Like, did you get it? So, preference share capital when you invest in it versus when you extend credit. Sometimes it's similar because there are percentages. For the debt, there is an interest rate. For the preference share capital, we have this rate. However, the maturity term is absent in preference shareholders. So, preference shareholders who invested in the company, they cannot expect that the money that they have contributed originally will be back to them after a maturity term because there is no maturity term for investing in preference shares and investing in ordinary shares. Okay? So that is still part of shareholders' equity and not liability, even if there is an interest rate. There is a rate here, preference rate. You understand? Okay. Now let's go to the twist for preference shareholders or preference shareholders equity. So we have what do we call as callable preference shares. Example, this preference shares in this problem is considered as callable preference shares. What does that mean? Those preference shares can be redeemed by the corporation if it wants to. So that's the easiest summary for the callable preference shares. So if we are the corporation, because our point of view in this lesson is we are the corporation, originally if we give, we are the corporation. And this is the shareholder. We give, we gave shares, 100,000 shares, and the shareholder will have to pay for cash, right? So that's original issuance of the preference shares. This is your entry if that happens. Callable preference shares. You can get this back, these shares. You can get that at a certain point in time if the corporation wanted to. So the power to get back the shares is vested on the corporation. So what will be the classification of this preference share capital and PSC share premium if the shares that was issued are callable preference shares? Nothing. It's still shareholders' equity, part of shareholders' equity. No twist at all. It's still like this. Okay? Why did I focus on the callable preference share aside from letting you know what is this so that you will not panic if you see this? I would like to compare it with redeemable preference shares. What if the shares that we're talking about was classified as redeemable preference shares? So, if it becomes a redeemable preference share, that means it could be redeemed by the corporation. If the shareholder wants to. So the power to, what do you call this, return the preference shares is in the hands of the shareholder. In here, the callable preference shares, the power is in the corporation, the power of choice. Whether to get it back or not, it's in the corporation. Shareholders' equity still, the PSC and the PSC share premium. How about redeemable preference shares? The shareholder has the power to return the shares at a specific point in time. Okay? So the power of redeeming or the option of redeeming is vested on the hands of the shareholder. So what will happen if these preference shares that were originally issued are considered as redeemable preference shares? This will become a liability on our part as corporation. Actually, redeemable preference shares on the A is equal to L plus C, that will be presented here in the liabilities instead of the capital. Okay? So it is somewhat like the subscription receivable that although it is a receivable, it is in the shareholder's equity. So it's something like that. And the share dividends payable, instead of being in the liability, it's in the shareholder's equity. The redeemable preference share, from the words that were used, redeemable preference shares, they are supposed to be part of the shareholder's equity, but it's not. It's in the liabilities. Okay? So what will happen? Cash, 2 million. Redeemable preference share, 2 million. And that is part of the liabilities. Because under the redeemable preference shares, not only the percentage is present, but also the term. There will be a term there. Like for example, the shareholder's term is 3 years. Then that means from preference shares, it became a debt, a liability. Because the maturity term is already present and the interest rate is also present. So, again, cash, and then redeemable preference share, 2 million. How about the dividends? If ever we're going to give dividends to these redeemable preference shares, like 10% times 1 million, something like that, that will be considered as interest expense. So instead of recording debit retained earnings unappropriated, something like that, and then we have dividends payable, what we're going to enter in our journal will be interest expense credit cash or interest expense interest payable. Okay? So those are the two twists of the preference shares. Next, we have convertible preference shares. Let's talk about that. What is convertible preference shares? Convertible preference shares are preference shares that could be converted into ordinary shares. For example, that is a convertible preference shares. And that could be converted into 5 shares, for example, of the preference shares can be converted into one ordinary share with a par value of, for example, 50 pesos, 50 each. So that is already a convertible preference shares. So this is your entry on the original issuance when it is not yet converted. But if it is converted, that will become preference share capital at par. It will be closed, 1 million. And the PSC share premium will also be closed. It will become ordinary share capital and ordinary share capital share premium. The question is how much? Of course, again, 5 of this is one ordinary share. So 100,000 divided by 5, that's 20,000 ordinary shares. So there are 20,000 ordinary shares here. Times the par value of 50, so 200,000 times 5. Let's solve it. 20,000 times 50. 1 million. Yan, it's 1 million. And then the ordinary share capital share premium is 1 million. Okay? So that's it. Sir, what are these features? Why are you putting on a lot of features on preference shares aside from this 10%? You are making it callable or redeemable or this convertible preference shares. It is because, again, we are the corporation and we need funds. And if we need funds, one of our options is to sell shares. And of course, the shares that we are selling will become more attractive if it has a lot of features. Okay? Like for example, on here, on the convertible preference shares, it will be very much interesting to the investors. It's because aside from being a preference shareholder right now, at the very beginning, they have the option to become ordinary shareholders, the real owners of the corporation, the owners that could impose significant influence or control to the company. Right? So, that's it for the preference shares. Next, I would like to talk to you about, aside from these things, aside from the preference shares, that means you will have here PSC and PSC share premium And it could be callable preference shares, but when we talk about redeemable preference shares, it should be presented on the liabilities. What are the other things that you need to know? Actually, you could issue a compound financial instrument. What is that? Example, you have a liability. You have a bonds payable. However, that bonds payable is considered as convertible bonds payable. So when you have bonds payable, someone has extended you money and you borrowed it. Okay? So you are the debtor and there is a creditor somewhere. So if you issue convertible bonds payable, that means your creditor can become an ordinary shareholder, because if we talk about convertible bonds payable, that means the bonds payable can be converted into ordinary shares. So your creditor can switch, what do you call this? A persona. Can switch persona. From being a creditor, he could become or she could become an owner of the company. Okay? Again, those are done so that the investors will be encouraged to invest, whether as a creditor or whether as a shareholder. For us, it's money in. Okay? So, we have convertible bonds payable. So, what will happen with this convertible bonds payable? First off, your bonds payable, if ever it will be converted, example, on the original, you have cash and then bonds payable. You have your accounting for bonds payable. So, for example, at this time, you have 2 million here and then 2 million here. Okay? So, if ever it is a convertible bonds payable, what will happen is the bonds payable will be closed and it will become OSC share premium, if that's the case. Okay? So, the bonds payable will be 2 million and then 20,000 shares, for example, because it could be converted into 20,000 shares. So, times 50, you have 1 million, and then OSC share premium is 1 million. Something like that. But when we talk about problems, sometimes it is phrased as like this. Each 1,000 bond, each 1,000 bond on the 2 million can be converted into, wait, wait, each 1,000 bond can be converted into 20 ordinary shares with a par value of 50. Something like that. That is the phrase in the problem. So, what will happen? How many 1,000 are there in 2 million divided by 1,000? That's 2,000 times 20. That's 40,000 shares. So, if that's like that, this will become 40,000 shares. The point is, it's stated just like that, the convertible preference shares. Like each 1,000 bond can be converted into 20 ordinary shares or 10 ordinary shares with a par value of 50. So 2 million divided by 1,000, that's 2,000 times 10. So 20,000 ordinary shares times par value of 50, 1 million. So OSC share premium is 1 million. Again, those features are introduced in order to, what do you call this? In order to make it, the shares that you are selling and the bonds that you are selling will be attractive to investors and you will have a lot of money. So to attract investors. Okay? Now, we have also compound. I have already said this, but um, I haven't talked about it because we talked about the convertible bonds payable. We have actually compound financial instrument like bonds with conversion option. Actually, if ever this becomes, what do you call this? This particular convertible bonds payable, initially, the entry is not just like this. That is what we call as bonds with conversion option. Actually, if you issue bonds with conversion option, for example, 2 million, actually you are not just paying for the bonds payable, you are also paying for the conversion option. So the complete entry of this is cash and then two credits. The conversion option is actually part of shareholders' equity and it is a family of share premium. So how do you make an entry actually? So when you make an entry, this is the simple conversion of bonds payable to shareholders' equity. You can uh, talk about this as if this is stage one, but actually, this is the real deal. I am just talking about here about the convertible, the conversion side. But if you wanted to master the compound financial instrument, the very first thing that will happen is that if ever you issue these bonds with conversion option, you will receive cash, of course. But you have to first compute for the present value of bonds payable. And then, the present value of the bonds payable, I have a separate video of this. Maybe, I have not taped it. But actually, I'll give you an idea. The principal of the bonds payable, you have to get the present value of that. Like for example, you have to subject that to 1 plus I raised to the power of negative n in order to get the present value of the principal. And then on the interest side, that times 1 minus 1 plus I raised to the power of negative n over I to get the present value of the interest. And then you will get already, if you add this present value of the principal plus present value of the interest, you will have the present value of the bonds payable. And for example, the present value of the bonds payable is only 1.8 million. That means the residual will be the conversion option 200,000. Okay? And if, so again, you have to substitute this to this. So we have now another account, the conversion option account, this one, that is added to the shareholders' equity. Okay? So, if ever it will be converted, instead of this entry, this is stage 1 again, this is stage 2. So, if it will be converted, the bonds payable will be closed. If ever, upon issuance in the afternoon, for example, your creditor said that I really wanted to become an owner, so please convert the bonds payable into ordinary shares. So if it will be converted, the bonds payable will be closed, your liability will be closed, and then your conversion option also, 200,000 will be closed because it's not already an option. It was already exercised. And then you have OSC, 1 million. Let's copy this. 1 million. And then OSC, share premium, the remainder. So 1.8 plus 200, that's 2 million, 1 million here, and 1 million here. So that's bonds with conversion option, the accounting of it. Again, when you issue bonds with conversion option to shareholders, to shareholders, conversion option to get ordinary shares, your entry will be debit cash because you will receive some cash from the investor, and then you credit the bonds payable. However, you have to remember to get the present value of that bonds payable because based on that, the residue will be on the conversion option. Okay? That will become part of the shareholders' equity. So in this part, it's as if the liabilities and shareholders' equity are being merged. they are meeting for the first time in this particular episode. From the redeemable preference shares to this. Okay? Next, we have bonds with share warrants. So, what is the share warrants? Share warrants are actually given to shareholders, if given to any party. If you have that, it's as if a coupon. For me, it's a coupon to buy a share from your company at a lower price than the fair market value. Like for example, share warrant is you can buy 5 shares. Oh no, stock options or share warrants, that's the same, is equivalent to 1 share with a price of 15. So you can buy 1 share at 15 pesos if you have 5 share options or share warrants. So that's not the same with the shares. It's another equity um, instrument, share warrants. So it's as if a coupon. So if you have 5 coupons, something like that, you can buy shares at 15 only. So this is what do we call as exercise price, 15. For example, the fair market value is 20. So you could save 5 pesos if you have 5 share warrants. Something like that. Share warrants is just like that. Okay? So, what will happen if the bonds is with share warrants? So, what will happen is that you would have debit cash, 2 million still. The same process. Bonds payable, you get the present value of your bonds payable. For example, 1.8 still. And we have the account share warrants outstanding, 200,000. So these share warrants outstanding are actually part of the shareholders' equity still. Okay? Which is a family also of the OSC share premium. So there are a lot of families of OSC share premium already. OSC share premium, PSC share premium, treasury share premium. We have stock dividends payable, fractional warrants outstanding. We have conversion option. We have share warrants outstanding. So as you can see, you have already an idea of what is a share warrant or share option. Okay? Again, the share option is very different from the shares itself. It's another equity instrument in which it acts like a coupon. That if you have that, you can buy share at a lower price, lower exercise price versus the fair market value. Okay? So I guess that's it for the compound financial instrument. The next thing that you should understand also, we have the watered share. What's a watered share? For example, there is a land that was given to you by a prospective shareholder and he said that is 5 million in fair value. So you have recorded it at debit land 5 million because the first priority for recording the non-current asset or non-cash asset that you have received is the fair value of the asset received, right? So you have given, for example, 100,000 shares with a par of 10, so that is 1 million. So OSC, share premium, 4 million. After investigation, it turned out to be 4 million only. Okay? So what will happen? You have to have a follow-up entry, which is discount on contribute on contribution, something like that. Discount on contribution, 1 million. Receivable, discount on contribution or receivable. This acts as a receivable. Discount on contribution or receivable from the shareholder. And then credit land. Because actually the land is only 4 million. So you have to wait for the shareholder to come clean. Because you have given him the shares worth 5 million, he has to give additional 1 million. Okay? Next, what are the next things that you should understand? We have share split. Share split two times. What is the meaning of that? Share split two times is actually if there are 100,000 shares and the par value is 10, so that is 1 million. If you see this share split two times, that means you have to times 2 the number of shares. So it will become 200,000. But the par value will be divided by 2. So it will become 5. There is no change in the total of the ordinary shareholders' equity or the ordinary share capital. The composition only. The par is divided by 2. The number of shares is multiplied by 2. That is what do we call as share split 2 times. Share split up 2 times. So, does this matter? Yes, especially if, for example, the company declared a dividend of 2 pesos per share. Of course, you're not going to base in the 100,000 already. If there is a share split up like this, you should base already on this 200,000 new number of shares. 200,000 times 2 instead of 100,000 times 2. Okay? Now, next is there is a share split down also, which is the opposite of this one. If this is the original data and this becomes share split down, what will happen is the 100,000 will become 50,000 because it will be divided by 2. And then the par value will be multiplied by 2. Instead of 10, it will become 20. It's still 1 million. There is no change still on the amount of the total amount of the ordinary share capital. The composition only changed the number of shares as well as the par value. Okay? So don't panic if ever there is share split. Next, sometimes you have this one, the organization cost. Organization costs are costs incurred in order to register or start the corporation. Okay? So actually, this organization cost is actually deduction only. You deduct it from the retained earnings unappropriated because organization cost is as if an expense. And expenses are normally, income and expenses are normally stored on the retained earnings. So if there is additional expense because of organizational cost, you deduct it in the retained earnings. Okay? And we have also share issuance cost. What is the share issuance cost? When you issue shares, for again for a lot of reasons like receiving cash, receiving non-cash asset, something like that. Sometimes there is a share issuance cost. Not sometimes. Most of the time, there is a share issuance cost. Those are costs incurred because of issuing shares. So if this is an expense and deducted, this organization cost is deducted on the retained earnings unappropriated, the share issuance cost is normally deducted on the share premium, OSC share premium. So meaning, just like this, the land 5 million, the OSC is 1 million, OSC share premium is 4 million. However, there is a share issuance cost of 20,000. What will happen is you have to you have to make an entry. OSC, share premium, 20,000, and then credit cash. But if there is no share premium, then the second priority is you have to deduct it in the retained earnings unappropriated. Okay, so I guess this is already complete. the redeemable preference shares, and etc., the pre-emptive right, the trust fund doctrine, and etc. So let me remind you of what we have talked about a while ago. First off, we started with trust fund doctrine, which is the legal capital should not be distributed. So on par shares, that is par values, less subscription receivable, so long as the subscription receivable is not collectible within 1 year yet, because it will become an asset. And then add also the subscribed share capital. For no par shares, you have to get all the contributed capital. Those are part of the legal capital that could not be issued back to your investors to protect the third-party creditors. Am I right? And then next, we talked about the preemptive right, in which if ever you're going to issue new shares, in order for the old shareholders to retain their ownership percentage, you have to give them the option to buy first. Okay? And after the preemptive right, we talk about preference shares, which is the same accounting with the ordinary shares, except that there is a percentage there, and that percentage is as if an interest rate times the par value, that is the share in the net income that they should receive first before giving the remainder to the ordinary shareholders. So although they are preferred in that one, the ordinary shareholders are the real owners because they could exhibit significant influence and control in the company. Okay, and we talk about the different types of preference shares. We have the callable preference shares, wherein those shares can be redeemed back by the corporation if the corporation wants to. And then the other one, although in the name redeemable preference share, it should be part of the shareholders' equity, it's actually part of the liabilities because the option to return the shares is on the part of the shareholder. So that is presented under liability, and any dividends that will be given to them is considered as interest expense. And we talk about compound financial instrument also. Compound financial instrument like convertible bonds payable. So if ever you issue convertible bonds payable, you have to debit cash. However, there are two credits. The bonds payable, at present value of the bonds payable, and the remainder is on the conversion option. And then if it is converted, that conversion option will be closed, as well as the bonds payable. And then you have OSC share premium if ever. The same accounting for the share warrants outstanding. If ever you are going to issue bonds with share warrants, what will happen is that cash and then bonds payable still at present value of the bonds payable, and the remainder or the residual will go to the share warrants outstanding. And share warrants outstanding, remember, the same with conversion option, is part of the shareholders' equity family of OSC share premium. Okay? And I discussed also what is the meaning of that share warrant. Share warrant is actually an equity instrument separate from shares, in which if you have those, you can buy a share at less than the fair market value. Okay? And after that, we talked about share splits. Share split down, share split up. Share split up, that means you have to or multiply the number of shares up, but you're going to divide the par value. The share split down, you have to divide the number of shares and you have to multiply the par value. Okay? So I guess the next episode that we're gonna talk about is a comprehensive problem and how to solve it using the knowledge that we have up until now. So thank you for watching and see you on the next one. Share this, click like, comment if you have questions, and share it to those who need it. Thank you again and see you on the next one.